Get ready, because the news cycle is absolutely exploding, and we've got the inside track on developments that are shaking up the entire landscape. The pace is relentless, the stakes are higher than ever, and if you're not plugged in, you're missing out on the conversations that will define the future. We're diving deep into the stories everyone will be talking about, bringing you insights and updates that you simply cannot afford to miss. From groundbreaking corporate strategies to significant market movements, this is your essential briefing. So, buckle up, stay sharp, and let's break down what's truly happening right now. First up, a major player is revealing an audacious plan to significantly expand its digital asset holdings, aiming for a massive stake in the total supply. This isn't just about accumulation. It's about reshaping financial strategies on a global scale and setting new benchmarks for corporate treasury management. We're talking about a bold vision that could redefine how major corporations interact with digital assets, projecting a future where these assets play a central role. This move signals a significant shift, and the details are absolutely fascinating. Then, we pivot to the financial mechanics behind such ambitious plays, dissecting the strategies and the potential ramifications. How are these massive acquisitions being funded? What are the innovative financial instruments being deployed, and what do they mean for investors and the broader market? We'll explore the intricate details of these financial maneuvers, uncovering the risks and rewards. Next, we're looking at the broader corporate adoption trend. A significant percentage of the total supply is now held by companies, and what this means for market stability and volatility. This isn't just a single company's move. It's a pattern, a growing movement that's changing the very fabric of how businesses manage their assets. We'll analyze the impact of this widespread adoption, examining both the stabilizing effects and the potential systemic risks that come with it. Finally, we tackle a deep dive into the strategic implications of this accumulation, exploring how these moves are influencing institutional adoption and what it signals for the future of finance. This is more than just numbers. It's about a strategic foresight that could pave the way for wider acceptance and integration. Stay with us, because you won't want to miss a single second of this. Make sure you're subscribed and the notification bell is on so you never miss an update. A bold new treasury vision, the 210,000 Bitcoin acquisition plan. Get ready for a revelation in corporate finance as Metaplanet, a company that has rapidly transformed itself from a struggling hotel business into a significant digital asset treasury, unveils an ambitious strategy to acquire an astounding 210,000 Bitcoin by the year 2027. This goal represents a full 1% of the total Bitcoin supply, a monumental target that underscores a profound shift in how major corporations are approaching their treasury management and asset allocation. At a recent Extraordinary General Meeting, EGM, held in Tokyo, Metaplanet's president, Simon Jurovich, shared the company's remarkable journey over the past 16 months and laid out the aggressive roadmap for achieving this unprecedented accumulation. Jurovich proudly announced that Metaplanet has already amassed 20,000 Bitcoin, elevating its position to hold the sixth-largest Bitcoin balance sheet globally, trailing only behind Strategy. He even set a further aspiration for Metaplanet to eventually hold the second-largest Bitcoin balance, a testament to the company's aggressive growth mindset. The strategy to achieve this ambitious target hinges on the innovative issuance of two new preferred equity offerings, dubbed Metaplanet Prefs. These perpetual preferred stock offerings are designed to be powerful fundraising mechanisms, drawing inspiration from similar successful models. Jurovich elaborated on how these preferred equity products, backed by Bitcoin, are poised to create a novel Bitcoin-backed yield curve. This curve has the potential to offer greater returns than traditional fixed-income products, particularly in Japan, where the company leverages the nation's exceptionally low interest rates, a factor Jurovich referred to as their hidden superpower. He highlighted that with traditional fixed-income markets facing strain, investors are actively seeking robust alternatives, positioning Metaplanet to become a leading issuer of Bitcoin-backed fixed income in Asia. Metaplanet plans to offer two distinct classes of preferred equity to cater to different investor appetites. Class A will be structured as a more conservative investment, akin to traditional fixed-income products, offering a steady 5% yield. Class B will carry a higher risk profile, but will include the attractive option for conversion into Metaplanet's common stock. Jurovich detailed 4 key advantages these new financial products will bring to Metaplanet, all designed to fuel its Bitcoin acquisition drive. The company's revised mission statement encapsulates this forward-thinking approach: to pioneer a new theory of credit in Japan and issue instruments built upon over-collateralized, absolutely scarce digital capital. The enthusiasm for Jurovich's vision was palpable, with shareholders overwhelmingly approving the proposed amendments to the company's Articles of Incorporation. The endorsement extended beyond the shareholder meeting, with notable figures like Eric Trump, a strategic board advisor, praising Jurovich's leadership and the synergy between Metaplanet and Bitcoin. David Bailey, CEO of Nakamoto, also lauded the company's strategy, stating that Metaplanet has become too big to ignore and is poised to become a systemically important institution for Japan. But how sustainable are these massive digital asset plays, and what are the real risks involved? We're about to break down the financial engineering and market impact of these bold corporate moves. Metaplanet's $3.8 billion Bitcoin financing, a high-stakes gambit for BTC supremacy. Metaplanet, a prominent Japanese firm that has aggressively pivoted to a Bitcoin treasury strategy, is making waves with its ambitious financing plans, aiming to secure substantial capital through a combination of share issuance and preferred stock offerings. The company recently acquired an additional 1,009 Bitcoin for approximately $112 million, bringing its total holdings to 20,000 BTC. This acquisition, executed at an average price of $102,607 per coin, represents a significant commitment to its digital asset strategy, even as its share price has experienced a considerable downturn. The capital for this latest purchase was partly sourced from Evo Fund, which exercised 11.5 million warrants, injecting around $65.73 million into the company. Additionally, Metaplanet utilized proceeds from redeeming approximately $20.4 million in previously issued bonds, demonstrating a multifaceted approach to funding its growing Bitcoin reserves. This corporate embrace of Bitcoin is part of a larger trend, with companies now holding an estimated 6% of the total Bitcoin supply. Analysts from J.P. Morgan suggest that this increasing corporate accumulation has a stabilizing effect on Bitcoin's price volatility, transforming the asset into a more predictable component of institutional portfolios. Metaplanet's strategy, while bold, is not without its challenges. The company's share price has fallen by 54% since mid-June, a decline linked to waning investor interest in exercising warrants, which directly impacts Metaplanet's ability to raise capital. To address these liquidity concerns and fuel its expansion, Metaplanet has outlined plans for a substantial overseas public share offering, intending to raise approximately $880 million. Furthermore, the company is seeking shareholder approval for a massive preferred share issuance, potentially generating up to $3.7 billion. This dual approach to capital raising highlights the scale of Metaplanet's ambitions and its determination to secure the necessary funding for its aggressive Bitcoin acquisition targets. The broader implications of these corporate Bitcoin treasury strategies are a subject of intense debate. Critics raise concerns about the inherent risks, pointing to synthetic leverage, where equity premiums can far exceed the value of the Bitcoin holdings themselves. This can lead to fragile capital structures, making companies vulnerable to sharp equity collapses if Bitcoin's price experiences a significant downturn, even without direct financial leverage. Another significant concern is custodial concentration, as a large portion of corporate Bitcoin holdings are managed by a limited number of custodians, thereby increasing systemic risk. While proponents view these strategies as innovative ways to diversify corporate portfolios and hedge against traditional market volatility, detractors caution against the risks associated with relying on such a volatile asset for core balance sheet strategies. The ongoing evolution of the market requires companies like Metaplanet to meticulously weigh the potential benefits of Bitcoin treasury holdings against the risks of liquidity constraints, custodial vulnerabilities, and the inherent volatility of the cryptocurrency market. But is this corporate Bitcoin accumulation a stabilizing force or a ticking time bomb for market stability? We're now going to explore the wider impact of companies holding such a significant chunk of the total Bitcoin supply. Corporate Bitcoin holdings surged to 6% of total supply. Stability or systemic risk? The landscape of corporate finance is undergoing a seismic shift as more companies embrace Bitcoin as a treasury asset, collectively holding an estimated 6% of the total Bitcoin supply. This growing trend, exemplified by firms like Japan's Metaplanet, which recently expanded its holdings to 20,000 BTC, is reshaping market dynamics. J.P. Morgan strategists observe that this increasing corporate accumulation has contributed to a noticeable decline in Bitcoin's price volatility, suggesting that these entities are acting as a stabilizing force in the market. This phenomenon is largely driven by early adopters like MicroStrategy, whose successful Bitcoin treasury strategy has inspired a wave of other companies, including Trump Media and Technology Group and GameStop, to incorporate Bitcoin onto their balance sheets. However, this widespread adoption is not without its critics and significant concerns regarding market stability and systemic risk. A primary point of contention revolves around the concept of synthetic leverage. Analysts warn that the equity premiums associated with these Bitcoin holding companies often expand significantly beyond the intrinsic value of their digital asset reserves. This can create inherently fragile capital structures. The danger lies in the potential for a sharp decline in Bitcoin's price, which could, in turn, trigger a precipitous collapse in the equity value of these companies, even if they are not directly leveraged in the traditional sense. This indirect leverage poses a unique risk profile that investors and regulators are closely monitoring. Furthermore, a critical issue highlighted by industry observers is custodial concentration. A significant portion of the Bitcoin held by these corporations is entrusted to a small number of custodians. This concentration creates a single point of failure, potentially amplifying systemic risk across the entire market. Should one of these major custodians face issues, it could have cascading effects on the holdings of numerous corporate treasuries. While proponents argue that Bitcoin treasuries offer a novel way for corporations to diversify their portfolios and potentially hedge against the volatility of traditional financial markets, detractors express strong reservations. They caution against the inherent risks of basing corporate financial strategies on an asset known for its price fluctuations. As this trend continues to evolve, companies are tasked with the crucial decision of balancing the potential advantages of holding Bitcoin against the substantial risks associated with liquidity challenges, custodial vulnerabilities, and the broader price volatility of the cryptocurrency asset class. These corporate moves are undeniably impacting Bitcoin's market behavior, but what's the long-term strategic play here? We're now diving into how these accumulation strategies are influencing broader institutional adoption and the future of finance. Metaplanet's strategic Bitcoin accumulation, paving the way for institutional adoption. Metaplanet's aggressive strategy of accumulating Bitcoin, aiming for significant stakes in the total supply, is not just a bold corporate maneuver. It's a calculated move with profound implications for institutional adoption and the future trajectory of digital assets in mainstream finance. By transforming into a Bitcoin treasury company and setting ambitious targets, such as acquiring 210,000 Bitcoin by 2027, Metaplanet is actively participating in a broader trend where corporations are increasingly integrating Bitcoin into their balance sheets. This strategic accumulation, coupled with innovative financing through preferred equity offerings, serves as a high-profile case study for how companies can leverage digital assets. The company's recent acquisition of 20,000 BTC, placing it among the top global holders, underscores its commitment and its role in normalizing Bitcoin as a corporate reserve asset. The approach taken by Metaplanet and similar entities is fundamentally reshaping the perception of Bitcoin from a speculative investment to a strategic treasury asset. This shift is crucial for attracting larger institutional investors who require more stability, predictability, and established financial frameworks. By issuing products like Metaplanet Prefs, which are designed to offer yields and can be backed by Bitcoin, the company is creating new financial instruments that bridge traditional finance with the digital asset world. These instruments aim to provide a more accessible and potentially lucrative alternative to conventional fixed-income products, especially in environments with low interest rates. This innovation is key to demonstrating Bitcoin's utility beyond just being a store of value, showcasing its potential as a foundational asset for new financial products and services. The success of these strategies could significantly influence regulatory approaches and pave the way for wider acceptance by more conservative financial institutions. Moreover, Metaplanet's public declarations and strategic partnerships, including endorsements from figures like Eric Trump and David Bailey, amplify its influence and credibility within the financial community. These validations help to build confidence among potential investors and signal to the broader market that Bitcoin treasury strategies are maturing. As more companies adopt similar approaches, the collective impact could lead to greater market liquidity, reduced volatility, and increased institutional demand. This, in turn, could accelerate the integration of digital assets into the global financial system. The challenges Metaplanet faces, such as share price volatility and the need for substantial capital raising, also serve as important lessons for the broader industry. They highlight the complexities and risks involved, prompting a more nuanced understanding of the operational and financial hurdles that need to be overcome for sustainable corporate adoption. Ultimately, Metaplanet's strategic accumulation is a significant indicator of evolving corporate finance, pushing the boundaries and creating pathways for greater institutional engagement with Bitcoin. We've covered a lot of ground today, from ambitious acquisition plans to market-wide trends. Let's do a quick recap of the biggest stories. It's been an action-packed episode, and we're wrapping it all up right after this. And that's a wrap on another explosive episode. We saw Metaplanet lay out a massive plan to acquire 210,000 Bitcoin by 2027, showcasing bold corporate treasury strategies. We dove into Metaplanet's $3.8 billion financing, weighing the high-risk, high-reward path to BTC supremacy. We also analyzed the trend of corporate Bitcoin holdings hitting 6% of the total supply, exploring the implications for market stability. Finally, we examined Metaplanet's strategic accumulation and its potential to drive institutional adoption. Don't miss out on any of these critical updates. Hit that like button if you found this valuable, smash subscribe to join the Bitcoin Bulletin community, ring the notification bell so you're alerted to every new video, and let us know your thoughts in the comments below. You can also follow us on all our social media channels for even more real-time insights. Thanks for watching, and we'll see you in the next one.